Household debt hits $18.8 trillion. What it means for you. Imagine waking up tomorrow and discovering that American households collectively owe $18.8 trillion. That number is so massive that it almost stops making sense. But here's the part that matters. This isn't just a statistic about the economy. It can affect your credit card payments, mortgage, car loan, monthly budget, interest costs, and even your ability to build wealth. So the real question isn't simply how much debt does America have? The real question is, what does America's massive household debt mean for you? Today, we're breaking down where household debt comes from, why it has become so large, and what you can do if debt is putting pressure on your finances. First, let's make one thing clear. Household debt doesn't mean Americans simply have $18.8 trillion sitting on credit cards. Household debt includes several major categories. The biggest is usually mortgage debt. Then you have student loans, auto loans, credit card balances, and other forms of consumer debt. And there's an important distinction. Debt itself isn't automatically bad. A mortgage can help someone buy a home. A student loan can help finance an education. An auto loan can provide transportation. The problem begins when debt becomes too expensive relative to your income. Think about it this way. If you earn $5,000 a month and have manageable debt payments, your financial situation may be relatively stable. But if debt payments consume a huge portion of that $5,000, you have less money available for groceries, emergencies, investing, retirement, and everyday life. That's where the real danger begins. So why has American household debt reached such a massive level? There isn't one single reason. One major factor is the rising cost of big-ticket items. Homes have become extremely expensive in many parts of the United States. Cars aren't cheap either. Education can be expensive, and everyday living costs can put additional pressure on household budgets. Then there's another powerful factor: interest rates. When interest rates rise, borrowing becomes more expensive. Imagine you carry a credit card balance from month to month. You're not just paying back the money you originally borrowed, you're paying interest on that balance, and if you only make minimum payments, that debt can take much longer to eliminate. Now multiply that situation across millions of households. That's when individual financial decisions become a much bigger economic story. One of the biggest warning signs for consumers is credit card debt. Why? Because credit cards can carry extremely high interest rates compared with many other forms of borrowing. Let's say you have a $5,000 credit card balance. If your interest rate is very high and you're making only small payments, the balance can become incredibly expensive over time. You may feel like you're paying every month. But if a large portion of that payment goes toward interest, your principal balance may fall much more slowly than expected. And that's why there's a dangerous psychological trap. A credit card can make something feel affordable because you don't have to pay for it all today. But eventually, the bill arrives, and when millions of consumers use debt to maintain their spending, the economy can become increasingly dependent on borrowing. Now, let's talk about the largest part of household debt: mortgages. For many Americans, a mortgage is the biggest financial obligation they'll ever have, and unlike credit card debt, mortgage debt isn't necessarily a sign of financial trouble. A mortgage is attached to an asset, a home. But there's still a risk. If home prices are high and mortgage payments consume too much of your income, your financial flexibility can disappear. And today's housing market creates an interesting situation. Some homeowners locked in relatively low mortgage rates years ago. Moving could mean giving up that low rate and taking on a much more expensive loan. This can discourage homeowners from selling, At the same time, people trying to buy their first home may face high prices and high monthly payments. So, the housing market can create a difficult balance: high prices, expensive financing, and limited affordability. Then, there are auto loans. Cars are essential for millions of Americans, but when vehicle prices rise, consumers may borrow more money and take longer loan terms just to make the monthly payment look manageable. And that's another important lesson. A lower monthly payment doesn't always mean a cheaper purchase. You could pay less each month but remain in debt for years. Student loans create another layer of financial pressure. For some borrowers, education debt can influence major life decisions: buying a home, starting a business, saving for retirement, or even deciding whether they can afford to have children. Debt doesn't always show up as a dramatic financial crisis. Sometimes it simply limits your choices. And that's one of the biggest hidden costs of debt. Now, let's zoom out. What happens when household debt becomes extremely large? Consumer spending can remain strong because people continue borrowing. That's good for businesses in the short term. But there's another side. When households become heavily indebted, they can become more sensitive to economic shocks. Imagine someone has a mortgage payment, a car payment, credit card debt, student loans, and almost no emergency savings. Now, imagine that person loses their job. Suddenly, those monthly payments don't disappear. The bills continue. This is why household debt can become important during an economic slowdown. Highly indebted households may cut spending when their financial situation becomes difficult. And when millions of people do that at the same time, businesses can feel the impact. So household debt isn't just a personal finance issue, it can also become an economic issue. But here's where this becomes personal. The biggest mistake isn't necessarily having debt. The biggest mistake is ignoring the cost of that debt. Many people focus only on the monthly payment. They ask, "Can I afford $300 a month?" But a better question is, how much will this actually cost me over the entire life of the loan? That question changes everything. Before taking on debt, look at the interest rate. Look at the total amount borrowed. Look at the repayment period. Look at the total interest. And look at how the payment fits into your overall budget. And most importantly, don't build your lifestyle around the assumption that your income will always increase. Because when your income stops growing, but your debt payments continue, your financial freedom can shrink very quickly. So, what can you actually do? Start with 4 simple steps. Number 1, know your debt. Write down every balance, interest rate, and minimum payment. You can't control what you don't measure. Number 2, attack expensive debt first. High interest debt can be particularly damaging because it grows quickly. Depending on your situation, you may choose a strategy such as paying the highest interest balance first while maintaining minimum payments on other debts. Number 3, build an emergency fund. Even a modest cash reserve can help prevent a temporary financial problem from becoming another credit card balance. Number 4, avoid adding new debt while paying off old debt. Paying down a balance while simultaneously increasing your borrowing can feel like running on a treadmill. You're moving, but you're not getting anywhere. The goal isn't simply to become debt-free. The goal is to create a financial system where your income gives you more choices instead of being consumed by monthly payments. America's $18.8 trillion household debt number sounds enormous, and it is. But don't let the headline overwhelm you. Your personal financial situation isn't determined by America's total debt. It's determined by your own numbers, your income, your expenses, your savings, your interest rates, your debt balances, and your financial decisions. The most important thing you can do isn't panic, it's understand. Know what you owe. Know what you're paying in interest. Know which debts are costing you the most, and build a plan to reduce them. Because in a world where borrowing money can be incredibly easy, financial freedom often begins with learning when not to borrow. If you found this breakdown useful, subscribe for more simple explanations of America's economy, debt, money, inflation, investing, and personal finance. And remember, the goal isn't just to make more money, the goal is to keep more of it. Disclaimer, this video is for educational and informational purposes only and is not financial advice. Always consider your individual circumstances and consult a qualified professional when appropriate.